Good afternoon, everyone. This is Glenn Thompson. It's just after 1:30 Pacific, and we're going to start. I just hit the recording button, so if you miss any portion of the presentation or if you'd like to review, we do record it, and you can get a copy or at least access a copy through Pacific Trading Academy. For those of you who haven't attended previous webinars and programs I've given, as you see on the screen, I've been affiliated as a consultant mentor with Pacific Trading Academy since the beginning. That's going on 17 years now. If you'd like to contact us concerning any of the programs, do so using the contact information. PacificTradingAcademy.com is the website, and the phone number or the toll-free number 800-339-8588. I haven't done a program or a webinar, I guess, on trading psychology, the psychology of investing, which is today's title. I think almost a year, if not more than that. So when they called me last week and asked me to have a seminar today, I thought it might be appropriate. I've been trading, as I mentioned a moment ago, I've been with Pacific Trading since the beginning, which is about 17 years. I've been actually trading for almost 35 years about. And at the time I started, going back that long ago, had I been thinking about, or if someone had approached me concerning psychological aspects of investing, I would have probably given it short measure and not thought of too highly concerning it. I was primarily focused on building a repertoire of tools and strategies and methods under or in response to the belief that that's all that was essential to be successful. Well, how things change. If you ask me today, what I believe is the most essential component to more greatly ensure one's success in the business of trading and speculation and investing at large, I would have to, if pressed, if I'm splitting hairs, have to say it has to do with the psychology, which really focuses on issues concerning the trader, the investor's internal state, what's going on inside internally, which in turn I believe has a lot to do with how you perceive the world and your responses to it, and specifically the choices you make in the investments and how you realize and come to those decisions. And that in turn correlates with the results you achieve and receive. So I place a premium of significance and attach the greatest amount of importance to psychology and the factors that impact and shape one's internal mindset, if you will. Having said that, I'm not saying that to have an appropriate, valid internal state that lends itself to the process of investing is sufficient to guarantee your success. ZDEs, thank you for letting me know. Apparently you don't have sound. Let me turn up before I proceed. Okay, can you hear me now before I go any further? Do we have sound? Okay, thank you, VJ. Yes, okay, at least please, the viewer, the listener who said you don't, okay, great. It seems as if the majority of people who are attendees can hear. If for any reason you can't, again, we are recording, so hopefully you will be able to make an adjustment. I have my volume monitors and mic turned up to the max, so hopefully you should be able to hear shortly, if not previously. And then again, if in the limit you're not able to, you can get a recording of this where it is being recorded eventually. But hopefully you will be able to follow along during the course of today's presentation. All right. So continuing on then, I thought it was a good time to talk about the psychology of investing, so that's today's title. About an hour ago, I'm constantly thinking about different insights and different things I can bring to bear to improve my own investing and trading. And when I present it to people I talk to, I'm always constantly trying to relate different things. The process of being a good trader and a successful one, I think, necessarily means that I'm constantly attempting, at least, to push the frontier. I want to learn more. I want to know. I want to be a better trader a year from now, 5 years from now, 10 years from now, hopefully, than I am presently. In the same way that I hope, and I am, a better investor and trader than I was 5 years, 10 years ago, and certainly at the beginning of my career. So it is a progressive enterprise and endeavor, certainly. The idea, from a practical standpoint, lest any new traders and investors out there get discouraged from the thought that, oh, that it's a never-ending learning process. Well, yes, but that we want to look at that and consider that as a positive, not a negative. Don't be overwhelmed by that. The good news, or even the better news, when we first recognize that we're continually learning new ideas in every aspect of this process, is that at some point, once you've subsequent to beginning the journey of learning to build your foundation of understanding, at some point you acquire enough knowledge, skills, and tools that exceeds a certain minimum threshold that will enable you to consistently be successful in dollars and cents, or at least more and more closely, progressively get closer to your personal objectives and goals. And that's the point. But having achieved those initial goals, typically we want to reestablish the bar. We want to constantly raise the bar. So on that note, about an hour ago, I had an insight. To me, I sometimes I'm too quick to self-attribute, but I think it's an important one. I dare I not think it too profound. It is what it is. But I'm going to mention something that I'm sure all of us have heard, whether we understand it on a technical level or if we just understand it colloquially. I think pretty much, we're all familiar and have heard of Albert Einstein and his famous equation, one of the most famous equations. Be you a scientist or a layperson, pretty much, I think, if we've been alive, if you're an adult, you've heard of the famous E equals mc squared equation. Okay. So let me repeat. E equals mc squared. Energy equals mass times c, which represents the speed of light, doubled, or squared. Hold on to that thought, because I had an insight concerning a solution, or at least one activity or pathway or set of events or actions one can take to further and improve their internal states, so as to create and continually be working towards an internal state that's most advantageous towards as in terms of a complement to the analysis part of this business. So remember, I'm saying at the beginning of today's presentation, let's put that on the shelf for the moment. The world, if not the most famous equation of all time, it is certainly in the pantheon of famous equations. It has permeated out into mainstream society. Again, you don't have to be a scientist to have heard, even if you don't understand, about the equation E equals mc squared. So I'm going to come back at the end of today's program and tie that in, and with an insight I had literally about, 45 minutes ago. Okay, let's proceed. Psychology. What is psychology? The scientific study of the human mind and its functions, especially those affecting behavior in a given context. One other thing, let me back up. I forgot to mention, because today's topic is referring to the emotional states or psychological componentry of the process of trading, the initial slides are going to refer and relate to that. But I have a little treat at the end. I know all of us love to see charts, and I'll give you my latest thoughts on two markets in particular. The last webinar I gave about a month ago, I think, was related to a particular trade that I was anticipating. I got in at about a week and a half, or actually just over a week ago, in the gold market. So I'll give you my latest updates on that and on the stock market. So hold on, I'm going to give you some quote-unquote meat, if you're thinking of it in that sense. Again, the point of today's webinar is to indicate, however meaty the analysis is, it's by itself, it's insufficient in my view. And I'm not just saying that simply because today's topic is what it is. In the scheme of things, there are three things I believe are what I always refer to as the tripartite essential ingredients to be successful in this business of trading. You need the analysis, and that's what most of us focus on primarily. Your understanding of the mechanics of markets and acquiring a set of indications and methods that enable you to exploit certain relationships that give you insights concerning the current apparatus of a market, that in turn allows you to project and get some clue as to its future state. And that's what we call making a projection or a forecast or arriving at or deriving a view. With that view in hand, you're then able to more readily put together, hopefully, an appropriate relevant strategy that will enable you to exploit your expectations for how a market's going to move, a stock, a commodity, any financial instrument should move, for so that the byproduct of your exploiting and apprehending and putting on a trade will generate a financial return. That's the whole point from a practical standpoint. I maintain that simultaneous with the analysis and of equal significance and integral to the process are two other components. There are three, it's a table that rests on a three-legged, it's a top that rests on three legs. It's creating a more stable foundation of understanding and procedure. The analysis, which is all serving to give you and locate the good trade, number one, is first and foremost, but it should be accompanied by an appropriate mental state. That's what the topic of today's webinar is going to concern. And money management. Money management is just the catchphrase that is related to issues such as the allocation of your money. How do you utilize in the best way possible, the most efficient application and adjustments of the investment part, the equity that you have to put into something, so for the purpose, so that hopefully the edge that the analysis has identified can multiply and magnify and increase. That's the whole point. All three of these things, the analysis or the tools or indicators or methods, whatever word, category, label you want to put on it, accompanied by money management, which is capital allocation protocols and rules. And lastly, but certainly of equal, if not greater importance, they're all kind of tripartite and equal partners in this venture, is the psychology. Okay. Now, someone's saying you still have no sound and no, just opening screen. Can you hear me? All right. If, okay, good. There's somebody out there. Double check. I have a number of times checked my settings, so I'm hoping you can rectify whatever audio problems you have if you cannot hear. If you can't, make adjustments as best you can to on your end, on your receiving side, because I'm having the majority of respondents indicate they are able to hear. I'm a little frustrated because I don't want anyone to miss what I have to say, hopefully. So ZDE, Zed, you still have no sound. I'm hoping that will change. So stay with us, do whatever you can. Well, if you, yeah. Well, I'm going to progress. You're going to be, a lot of the slides that I have are you can read it. So as if you didn't have oral capacity, you'll be able to read. Okay, good. Most of everyone is saying they can. No action. All right. What happened to the presentation? Oh, thank you, Alan. Try logging. Well, if you can't hear me, I don't know, but all I can say is if you hear anything, log out and log in again is a suggestion one of the respondents. All right, try it again. Reestablish your connection is hopefully. All right, hopefully, Alan, they can figure that out, maybe, or retry if they're motivated. But anyway, I'm going to proceed since the majority of attendees seem to have audio and visual. Okay. So we're going to tie the E equals MC squared equation into the end of the program as a working concept if it can help to, in a formal way, optimize your internal state so that it will be an appropriate adjunct to your investing tools. All right. So, I skipped a slide. Psychology, the scientific study of the human mind and its functions, especially those affecting behavior in a given context. So the context I want to talk about specifically today is that of investing, trading, whatever you want to call it. Okay. That's just a general thing. Trading psychology, the necessity of ensuring an internal emotional state appropriate to the speculative process. I'm going to skip this. I should have deleted this slide. This is something I wrote. It doesn't quite fit. You can, if it's of interest to you and you get the copy, you can. I'm getting no audio. Again, a respondents. Are the majority of you still hearing? Can you hear me now? Nothing, Steve. I don't want to proceed if too many people are not hearing. Okay, okay, great. Thanks, AT&T. Good. Trading as an enterprise. Okay, and this slide indicates what I just said as a preface. In general, what most of us think about when we think about locating a good trade is that activity depicted on the left side of this screen of the slide presentation here, the left, analysis. And there's infinite number of things, indicators, methodologies. There are two basic types of analysis that we normally think of, the two philosophies or camps or paradigms, the fundamental, the technical, and then maybe there are hybridizations. There's the quantitative approach that's grown up more recently in the last 30 years or so. But more or less, there are a number of different approaches that for all developed and refined and tweaked and adjusted and played with and utilized for the purpose of helping you and I locate good trades. That's on the left side. But let's assume you've optimized, you back-tested, you've spent years putting together, constructing a very effective, high-performance methodology. That by itself is insufficient to generate your I could say to that extent you have mastered analysis. You have acquired a degree of acumen and understanding and facility and ability in wielding a methodology. But that is woefully, terribly falls short of being an effective profit from the metric of dollars and cents trader or investor. If, from a practical, real-world standpoint, your objective, your ultimate goal is related to dollars and cents, mere analysis, unless you are a quirk of circumstance, is not likely to get you there. Yeah, you can say you're a great analyst, and that there are two separate distinct disciplines that are essential. Putting aside the money management stuff, you've got to. There's the analysis, again, which is developed and utilized and slated for the purpose of enabling the participant, the observer of market action in motion, to locate value trades. Where's a good trade? That's the whole point. I could wrap that up. The entire lexicon of all the last 200 years of thought and development and experimentation and research, all for the purpose of developing systems, interesting, elegant theories and indicators and methodologies. And that's analysis. But the point of all that is to enable first an understanding of the system that you're observing and hopefully trying to become a part of, and as a consequence of that interaction derive a financial outcome or a return. That's the analysis. But the psychology is essential to act on the results of the analysis. And so there are behavioral, as we see, if we shift, so that is a necessary complement to the analysis. There are great analysts who haven't made a dime, as in the extreme. That's not saying being an analyst prevents you rather, it is complementary to the process of being a speculator or a market operator or investor or a trader, whatever phrase you want to use. It's a separate discipline. It happens to dovetail and, in a tangential sense, meet up. It should. It's necessary that the two components or ingredients for the entire enterprise collectively rendezvous and have a nexus of connection. Otherwise, you are operating kind of like as if with one hand tied behind your back. You're at a disadvantage. You're handicapped. So psychology is essential. If you have an inappropriate internal state, that is a bad psychology, for a catchphrase, you're not going to be able to utilize the output of your analysis. However grand an analysis, however elegant and powerful and relevant and accurate and reliable the analysis is, if you don't have a mental template internal in your own self, it will die dead and inactive. It'll never get to the market, and you'll never see a corresponding financial return. Thus, the reason for taking steps and measures to counteract impediments to developing that correct internal state. All right. Faulty reasoning. That's a cognitive bias, meaning it's more intellectual, it's cerebral, and emotional, born of intuition opposed to conscious thought. All right. Just to give you a self-attribution. I mentioned this at the outset. This is something I have to personally kind of watch out for. I tend to be too quick to attach too grandiose a report on some new idea I come up with. And so I have to, we got to be quick to guard against this tendency to ascribe your success to skill or hard work, to blame your failure on external factors or bad luck. Dangerous. If we don't perceive errors as errors, we can't learn from them. All right. Attributing lucky outcomes to skill can lead to overconfidence. A real-world bad outcome of overconfidence is you tend to trade more aggressively than you should. Overtrading, overtrade sizing is a specific negative symptom. It's a symptomatic of being too readily attributing positives to yourself and your activities, and too easily blaming your shortcomings on external factors or factors other than you. All right. So we've got to take a caution measures against the self-attribution component of our internal state. Overconfidence, which is a cerebral or a cognitive bias. An incorrect view is that the lack of confidence, this is an important point, a lack of confidence is holding you back as a trader. Okay, let me repeat. An incorrect view is that a lack of confidence is holding you back as a trader. So, versus acquiring and developing skill and learning to be confident in the skill. Overconfidence leads to overtrading, an incorrect assessment of risks associated with extreme moves, both of which hurt the long-run outcomes. Most important thing to remember is to stay in the game. Once you have an edge, if you can play long enough, that is, continue to investing or continue to do your trading, the law of large numbers will eventually make you rich. Don't jeopardize your future trading. I tell people to put into context whatever system they are employing and wielding and using, you adjust it, and in order to adjust it and use it such that it will allow for as many trials as you can, so as to lengthen the window of time within which you utilize your methodology. Why is that important? It allows the law of large numbers. The more times you repeat something, anything, the phenomenon, the more closely the statistic that defines the performance of that thing, that activity, the more closely you approach that optimal performance ratio, let's say. All right, make sure, can you guys still hear? Hopefully so. Good. I'm getting positive feedback. Good. All right, moving on real quick. The availability heuristic. This is a pitfall, an emotional pitfall typically. I'm not sure if it's a cognitive one or an intuitive or emotional one. Nevertheless, it's a problem. And that is simply being, seizing the first good idea that comes along and assuming it's necessarily the only one that's correct in your now. And this is how it's a mode of interpretation, or it's an obstacle to valid interpretation. All right. The tendency to base decisions on the first piece of evidence that comes to mind. Estimation of the likelihood of events on the basis of how easy those events are to imagine. Just because you come up with a good idea doesn't make it wrong or invalidate it just because you've come up with it on the one hand. But what the point of this is, that is not going to create a problem if you don't validate it necessarily. More likely you have a bigger problem in the bigger picture of things is if you are too easily ready to validate an idea that you seize upon or that you just happen upon, and because it seems correct on the surface, or at least initially in a superficial sense, you assume it is the perfect concept and idea concerning whatever it is you have in your conjecture and you have in consideration. Be careful to guard against that as in terms of your internal thought process. I'm often guilty of that. Short-term thinking, the irrational preference for short-term gains at the expense of long-term performance. Okay, this is an important point. What the concept depicted on this slide is not referring to is, it's not referring to it in a very specific sense. I'm not saying better to be a long-term trader versus a short-term trader. It has nothing to do with the window of time that you enjoy trading in. You could be a hyper-frequency day trader on one extreme, or you could be a long-term portfolio manager on the opposite extreme, or you could trade in any interim window of time or period, swing trader, position trader, kind of a longer-term day trader, etc. On the continuum of possible time windows or time horizons you tend to prefer, that this slide or this concept has nothing to do, it's not referring to that. What it's saying is an irrational preference for short-term gains at the expense of long-term performance. This is a subtle point that this slide, this idea is bringing up, and that is, a good example is options. We know that if you're selling premium, for those of you who understand options, I'm using this as an example. You're selling premium, you have a finite return, whereas and it's typically in a position that's a shorter term position than if you're in a long option position. You are long premium versus short premium, or if you've written premium. The potential returns for a long option position are open-ended, unlimited, if you understand option mechanics, versus the potential maximum return on a short option position is finite. But just because that is the way it is doesn't make one better than the other. Often, as an example of what the concept on this slide is indicating is, don't necessarily in and of itself, don't prefer a shorter term, don't obviate or obscure from your view the potentiality of a gain which can be obtained and realized in the real world from a longer term strategy versus a shorter term strategy. Evaluate the strategy on all merits. A 360-degree evaluation is this concept. Don't assume just because you can make smaller amounts of money more frequently, let's say by selling premium, using that as just as an example, that it's inherently on all fronts, all the time, under all circumstances, given all market scenarios, a better strategy versus buying an option, let's say, for the longer term, given all the potential attendant problems or hindrances in that strategy. Every strategy, long-term, short-term, has benefits and limitations or hindrances. Evaluate the strategy on all fronts, 360. Don't assume, don't necessarily focus solely on the short term simply because you think it's better. In and out, the term of the strategy is not the sole determiner of its merit. Okay, that's what this is saying in a nutshell. So be careful of that. All right, loss aversion. Oh, this is critical. This is clearly an emotional bias. Let me double check. Are we still, do you guys, can someone just give me feedback? Are you still hearing the slides? Anyone? Okay, hopefully so. Great. In order to consistently win over the long term, if there's anyone out there, just make sure, just give me a plus. I don't want to proceed with that. Okay, good. Going back. Hopefully we still can hear. Okay. All right. Questions? You still there, guys? All right. Hopefully so. I'm not getting any feedback. That's why I'm slightly hesitating here. Questions? I'm assuming you guys are still there. Okay. All right. Loss aversion, emotional bias. Excellent. Thanks, Bob. All right. I feel more comfortable proceeding. Loss aversion, which is stems from an emotional bias. In order to consistently win over the long term, it's necessary to accept losses. Let me repeat that. That might sound a little, or very, depending on your perspective, counterintuitive to the object of the game here, to make money. In order to consistently win over the long term, it's necessary to accept losses, even to the point of seeing them as no more than the cost of doing business. I would submit that's a very good way to see losses. Instead of naming or labeling them as losses, redefine them as business expenditures. Studies show people dislike losses more than they like gains. Yeah, they've done actual studies. Fear is 2.71 times more important a motivator or a driver. Fear of loss, it then is our desire, our avarice, our quest for profits. Thank you, Roy, for being there, for giving me that feedback. Studies show people like losses more than they like gains. This leads to get-evenitis, a condition where traders hold on to losing positions too long as they hope for them to rebound so they can exist with a scratch. We don't get into this business to break even. I know many people, the results, the statistical profile of the masses of investors over years is at very often the optimal outcome is a scratch, much less net losses. Ace Greenberg's famous quote, "The definition of a good trader is a guy who takes losses." Again, I'm purposely, to make a bigger point by the end of the slide presentation, pointing out, highlighting concepts that might, at least initially, hopefully they don't, but if they do, seem on the surface to be counterintuitive to in the extreme absurd. Where did this idea from? A good trader takes a lot of losses? Yes. Now, let me add, now that we've got your attention is the thought that would follow, and let me contextualize this. As long as they are proportionately small to your starting amount of equity, the money you have. But losses are by themselves not intrinsically bad. They're not a bad thing necessarily, as long as they are of the right proportion relative to what you're doing and your methodology in the edge. So in a context. So that's an important point. Confirmation bias. Once we have formed, this is critical. Many of us, if we're human, this is clearly more of an emotional thing, I think. Once we have formed an opinion of a situation, we react differently to confirming and contradictory evidence. Once you've attached yourself to a viewpoint, and this applies to the markets, but it clearly is more universal. It applies to your views and everything in life very often as human beings. So it's a problem. It can, if you buy into this or if you apply this, it could hurt your trading. Once we have formed an opinion of a situation, we react differently to confirming and contradictory evidence. Specifically, we emphasize confirming evidence and downplay contradictory evidence. An experiment that was done in 2004, 30 men included in the study, one half Republicans, one half Democrats, were given a questionnaire. During an MRI scan, they were scanning their brain activity. Subjects were asked to assess contradictory statements by the conservative Bush and the liberal John Kerry. The brain scan showed that the part of the brain associated with reasoning, the dorsolateral prefrontal cortex, was not involved in assessing the statements. The most active regions of the brain were those involved in processing emotions, conflict resolution, making judgments about moral accountability. This means that after a certain point, we are not gaining anything new from new evidence or information at all. It indicates it's kind of like the nonlinear behavior of an oscillator. Think of an RSI, or certain of the generic oscillators to relate it to a tool, a common generic tool that we all as investors may have familiarity with, a stochastic, an RSI oscillator, let's say. It's on a set fixed scale of 0 to 100. What happens if the mark, and more or less there's a direct correlation between the reading on your oscillator scale and the price. Price continues to trend higher, and more or less as the price rises, so too does your oscillator line, up to a point, 100, let's say, where the scale ends. After that, assuming the price of the market continues to rise, it's continuing to persist higher, there's a nonlinear response on the part of the indicator. There is, in a similar sense, a nonlinearity of understanding, of response, of reaction on the part of you and me, or there could be, which could, in a very bad way, impact our understanding of the situation and therefore impede our attempt to profit from what's going on in the market. If after a certain threshold, that's the final sentence here, this means that after a certain point, I am firm in my opinion. This is my final answer. I'm not budging from it. There's nothing you can say or do or show me that's going to change my view. How silly is that? Well, it's because I understand the reason. There's comfort in building a foundation in your belief system. You finally arrived and you can plant roots. You can lay camp, set camp. We're solid. We're on a solid, we've got ground underneath us. We're supported, we're stability. I get all that. But that's the good news of it. You got support, you got stability, but ask yourself in the real world, let's dig into this. How is that necessarily going to do you well if you were dealing with a system that's nonlinear, that's constantly in flux? The stock, the commodity, the currency, the financial instrument, it's changing. It might be stable one moment and a microsecond later giving you a whole new set of information. If we are not in sync and moving in flux with it, if we're not moving correlated with that system we're tracking, woe is you, woe is me. Good luck with that. Yeah, you're going to begin to depend more and more greatly on luck as opposed to objective analysis and assessment and measurement of the system you're trying to apprehend and interface with in a manner that the reaction will throw off capital to your account. Be careful. Hindsight bias. Once an event has occurred, we tend to think that the event was predictable. A single realized outcome is far easier for us to grasp than the multitude of possible outcomes that did not occur. This leads us to overestimate the accuracy of our predictions as we retroactively fit them to data. This also goes by the name of I knew it all along effect. An obvious danger of this phenomenon is that it very often leads to trading over with a size that you shouldn't. This is probably a cognitive failure, misstep. It's a function of the complexity inherent in financial market structure is overwhelming. And as such, and our feebleness, our brain, our cognitive capacity to comprehend stuff is no match for the possible magnitude or volume of permutations of type of behavior that are latent and pregnant internal to a market's motion. And so we tend to, in an effort, we tend to simplify, and in that simplification we lose reality. We lose a grasp of what's really going on. All right. So we've got to be careful against this particular bias. Here's an important, this is what I alluded to at the beginning. On the left side of this page or slide, there are two basic camps or paradigms or approaches. And that's what most investors and traders and participants that are attempting to profit in the business of investing do. We spend most of our time, as we should, at least initially. You got to build a foundation. Again, acquiring the appropriate, relevant, most optimal internal state, that is focusing on the trading psychology of your business, is not some mamby-pamby stuff of me. It has nothing to do with every morning before you turn on your screen and turn on the markets and see what's going on and begin your analysis. You repeat 100 times in the mirror, I'm a great trader. I'm not saying you shouldn't do that, but I am saying if you do that and that's all you do, and assuming you're going to realize your objectives, good luck with that. It has nothing to do with ensuring an appropriate mental narrative that's constructive and supportive and reinforcing the stuff on the left side of the screen, your analysis, your tools, like the hard stuff, meaning hardware versus software, type by analogy is the metaphor I want to present. But go back to the left side. Whatever type of analysis you do, anything from A to Z, you could be, candlesticks, moving, I don't care. That's not the subject. Whatever you do to locate your edge and for the purpose of exploiting, merely having done that, the output of your fundamental technical, counting pigeons on a telephone wire outside of your bedroom window and having identified some magnificent correlation between that and what the stock market's going to do that morning. I mention that because I know somebody who does that. Don't ask me how or why. It is what it is. I don't care. That's irrelevant. If it works, it's effective. If it consistently leads you to edge, it's good. Okay. But, however, I don't care how great it is. It's worthless if you can't get it over and transport and export the output of what you've done on the left side of this page to the right side. It's going to fall out. It's vacuous, empty, worthless. If your objective is to profit in in dollars and cents. Think about the number of times you've looked at a price chart and said to yourself, it looks like the market's going to go one way or another, and what you thought was going to happen actually happened. You had a confirmation, you just witnessed confirmation of the very output, your analysis, whatever it is, anything you utilize and you feel is relevant and helpful and important and effective. Whatever it is, however effective it is, you saw it, you got confirmation, feedback to you that it worked. However, you did nothing except watch the market move while you anguished over all the money you could have made as a consequence of applying, notice I said of using, implementing, putting into action the output of the numbers that you came up with, or the price levels or the price support and resistance zones and the trajectories and all the details of your analysis. You've got to sell it to your internal state. Otherwise, it's going to be in a database in some computer file, or it's on a piece of scrap paper, and it's lifeless. The market doesn't know anything about how many books you've read, how many courses you've taken, if you're a genius concerning it. And I always tell the people I consult, more to the point, if a market, any market, stocks, bonds, commodities, you name it, options, swaptions, currency pairs, if a market could comprehend anything in the world external to it, assuming it could care less. Markets just flow, by definition, from one level of price to another. Pay no attention to the man behind the curtain. Pay no attention to the phone ringing in the background. I thought I'd muted that. But so, anyway, this is an essential point. So, there must be a process in the middle of this screen that takes place. A sales job must occur. I worked for a research institute, Pegasus Econometric Group, many years ago. The head of the firm taught me something concerning the importance of sales. I used to downplay it and think and relegate it to a mediocre, plebeian state of existence. No, everything in this life, in our universe, and if it's to make a mark and be registered in a broader sense, it has to be sold, and as such it assumes a degree of, it's catapulted to a higher echelon. I don't care, you could have the greatest, you could have come up with the most powerful, elegant, effective, and profitable methodology. If you don't use it, how good is it? You know, it's kind of like analogous, if the tree falls in the woods and no one's there, does it make the sound? By extension. Anyway, I think, so this is an essential componentry, and to make in effect that smooth, efficient sales, to transfer or export the output on the left side of the screen, however good or bad or relevant it is or isn't, over to the right side, that's where that's the reason an internal state, the trading psychology, is an essential component to more greatly ensure your success. I cannot overemphasize that. How do you get from the output, the stuff over here on the left, how do you transport that to the right side, inside of you, to the point where it's such an intensity, it compels you to press the keyboard, 20, 30 years ago, to pick up the phone and place the order with your broker, so that ultimately there's a registration of an event at an exchange or at a market somewhere, so that you have a chance to generate, money into your account, which ostensibly will make an impact in your life, or enable you to realize your objective in the generalization of it. Bottom line. Bottom line. How to make the jump. In order to make the jump, you must identify the characteristic that separates the consistent winners from everyone else. Here it is. Winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions. Therefore, they are no longer susceptible to the common fears and trading errors that plague others. All right. Just check in. All right. Moving along on that. The obstacle. What's the hindrance? Why is that difficult to do what this slide says? Why is it challenging? Why don't we understand it? It's nothing hard conceptually. We can all understand, I think. If we can't, that's why you need coaches and mentors and teachers and assistants, people to give you insight and feedback, to guidance. That's nothing wrong with that. Winners have attained a mindset. How did they attain it? Of attitudes that allows them to remain disciplined, focused, confident in spite of whatever is going on, the circumstances. Forget the circumstances. Sometimes they're going to be positive. Your response or thought on them will be that they are good. Other times they'll be negative. Winners, regardless, they continue to win and do what they do, regardless of the flux in the type of circumstances that arise in day-to-day living. They're no longer, and as such, to that extent you can approach that state of being internally first, is the extent to which you less and less reduce your susceptibility to common fears and errors that are output or symptomatic of those fears and that plague the majority of traders. The obstacle. Why is it hard? Emotional pain, financial disaster are common among traders because trading is full of paradoxes, contradictions, and I would add counterintuitive events, things that don't make sense in our brain. Well, let's think about that. Stuff that doesn't make sense. I thought of this when I was reviewing this slide last night, thinking about how to make it more meaningful, and I thought of the thing that I remember years ago learning, and on first learning of it, I thought it's ridiculous, it's so absurd and doesn't make so sense. So many things in my life don't make sense, but they are. Certain things you just have to accept because you see the evidence and the pattern of their acceptance and their reality. Whether it's intuitive, naturally seems to add up to you, to quote a phrase, or otherwise. If it is, it is. There are many things that I acquiesce to, I see are correct. It is the case. It is a state of being. It represents what is. whether or not I understand it is a secondary thing. I might, for my emotional comfort, like to understand why certain things add up and make sense, but that's great if you can have that state of understanding concerning a phenomena or something you're doing. But that doesn't mean that just because something doesn't make sense, it's not valid or the reality for that situation or that thing at that time. For example, I'm just going to throw this out there. One of the most, not the only, I have many things in my life and existence that are in the extreme counterintuitive or even more extreme absurd, but they are real, and they are what they are, and they represent the reality if there is such a thing. For example, if you were to add up all the natural numbers and continue, my common sense tells me that if you kept on along with that process, you'd come to some unimaginably large number, like a Google or a Googleplex, or think of the largest. But if you continue to count forever, you know what you'll get? And this is fact, or it is a truth. You'll get -1/12, a little fraction. That's one of the most extreme things I have ever encountered or come to terms with. I may not understand it. I might understand it. You may understand it. You may not. But it's a reality. If you were to continue counting in a series all of the natural numbers and just continue with that process, what do you get at the end of the day? A fraction, -1/12. Okay, I use that as an extreme example. Let's move on. So I cited as Exhibit A as an extreme. If you understand what I just said, that's great. It's not extreme. That's because of those types of counterintuitive scenarios, assuming it is, or contradictions or paradoxes, it is a challenge. That's the problem. The corresponding solution. Let's move on. You've got to accept them. Contradiction. Unsuccessful traders are obsessed with market analysis. Get that. Unsuccessful traders are obsessed with market analysis. You know, that's easy to come to grips with. Yeah, because if you're not successful as a trader, and when I say as a trader, I mean you're not making money. The prima facie, a priori here is that to be successful, one and the same is you are achieving or en route or consistently realizing your financial objectives. That's what I mean when I refer to or allude to a successful trader. So an unsuccessful trader is one who's not achieving that objective, not realizing their financial objectives, a priori by definition. So what is this slide saying? Unsuccessful traders are obsessed with market analysis. Well, I guess so, because they're not too obsessive with being a successful trader. So they got to obsess with something that they're good at by default, market analysis. If I can't be successful as a trader and I can be successful as an analyst, I have a claim to fame. I have something I can be satisfied with. It makes perfect sense. They crave the sense of certainty that analysis appears to give them. In my experience in coaching and teaching and mentoring, this astounds me. I was guilty. I was a practitioner of this when I first began, because I thought that what it took to be a successful quote-unquote operator, market speculator, trader, was finding the perfect methodology or system. I had no idea. Now what this is not saying is that you should be. This is not in the slightest even inferring or suggesting that you should. It's not licensed to not develop the best methodology and systems and understanding. Certainly the opposite. You want to do the very best you can to constantly optimize your methodology and analytics. Clearly, it's referring to something completely different. Unsuccessful traders attempt to create certainty where it just doesn't exist. Markets are not certain. They are counterintuitive sometimes. Sometimes they're intuitive. They're a hybridization. The complexity is astounding, kind of like weather and the componentry and the vectors that are responsible for creating our weather and our atmospheric phenomena. Ironically, once the fact that certainty doesn't exist is accepted, an alternate certainty is derived. Okay, that is the absolute certainty that certainty doesn't exist. That's the problem. Okay, here, let me repeat that. We have once the fact that certainty doesn't exist is embraced fully, and you thereby, in response, you carom off of that idea and you realize, aha, there's something that serves as a context and a backdrop to all of my activity when I do my analysis and I put my trading cap on and I call myself a Mr. Investor, and I'm going to be, I have open-ended potential to make unlimited amounts of money, whatever it is, millions, tens of millions, hundreds of millions, billions, etc. An alternate certainty is derived. That is the absolute certainty that certainty doesn't exist. Rest in that. That's a comforting thought if you can get to the point where you accept it as such, clearly. Certainty doesn't exist in this activity. There's a reason I want to emphasize that. That's the problem. Here's the answer. If we understand and accept prima facie that certainty doesn't exist every time we place an order and establish a position in a market, but instead there will be a spectrum of outcomes. Number one, that's a reason sufficient to stretch out and repeat or iterate the process of your trades as many times as often. Extend, that's referring to what I mentioned previously a few minutes ago. Any and everything you can do to flip the coin more times or place the trade a greater number of times versus a lesser number of times will automatically, implicitly invoke the law of large numbers to begin to become an analytical ally of your methodology, your system. The law of large numbers, the classic textbook statistical example is when you flip a coin, you're going to get an outcome of a distribution of outcomes that says, or the statistics say in a textbook, and if you were taking a stats 101, 50% of the time you get heads showing, 50% of the time you get the tails pointing upward. Well, that does not mean necessarily if I flip a coin 10 times, I'm guaranteed 5 of the outcomes of the tosses will show heads pointing up and the alternate final 5 tails. It's a possibility, but it is almost infinitesimally improbable to occur. Next to impossible, but it's not impossible. I can't rule it out. What the law of large numbers says is, referring to that example, an obvious textbook one, the more times you flip the coin. If I flip the coin 1,000 times, 10,000, 10 million, the more times you flip that coin, the more closely you approach a 50-50 distribution of outcomes. That's all it is. So apply that to your trading. That has certain specific ramifications in terms of how you allocate your money, the equity in your account. When you see, once the analysis has pointed you to a good value, or what we hope is a good trade that gives you edge. What does this mean? Trading is inherently risky. Okay. It's inherently risky. In other words, no trade is a guaranteed outcome. Therefore, the possibility of losing money is always present. Naturally, someone might consider themselves to be a risk taker in this environment. Okay, well, that's what we're up against up at the top, that first paragraph. What do we have to counter to? That's our foe, that's our enemy. What's our arsenal? What's our weaponry to counteract against that inherent risk? We're entering into a zone of risk, the risk zone. The best traders not only take the risk, here's how you offset and mitigate and lower and create an environment suitable for you to take money out of this risky neighborhood. The best traders not only take the risk, meaning you've got to embrace fully the risk. They've learned to accept and fully embrace that risk. To whatever degree a trader has not accepted the risk is the same degree to which he or she, I should say, in case there are women out there, avoid the risk. If you don't embrace and fully take as part of the program all of the risk, it's the same. You're going to attempt to avoid it, because you know that risk leads to failure and financial loss, and that's the counter objective. That's the opposite of what you're trying to do. So naturally, common response is, let's avoid the thing that will lead to the very opposite of what my objective. Trying to avoid it. But that's a problem. As intuitive and commonsensical as it sounds, trying to avoid the unavoidable. Trying to avoid something that is unavoidable will have catastrophic effects on your ability to trade successfully. So it may seem strange that you're trying to live amongst the risk neighborhood or area, but that's the solution to dealing with it. Kind of like a Trojan horse. You've got your army, but if you present it front and center, you just go up in front of your opposing force and show all of your strength. Yeah, they're in a better position. You're susceptible. Disguise it. So one of the best ways to disguise something is to make it front and center. Put it out in front. It's so obvious, there's a perceptual blindness that develops. You can't see the thing that's right in front of your eyes. By analogy, that's not the only thing but that's one way that just came to my mind. This concept, to overcome the type of environment that the process of investing is in, you've got to welcome what on the surface might seem like you should try and push away. You've got to invite in the thing that your initial instinct might suggest, try and push away. Do the opposite of what your instinctual drive might suggest, and you're going to begin to do things, move towards a more perfect internal state. Steps in probability thinking that Mark Douglas came up with in some of his material years ago. Anything can happen. Yeah. There's open-ended, infinite possible permutations. The greater the complexity of the system, the more possible, the higher the complexity, the more challenging it is to figure out, much less figure out where it is right now, much less in the future. And we're dealing with a system that's changing. We want to know what the market's going to do tomorrow, an hour from now, 5 minutes from now, next year, and everything in between. You don't need to know what is going to happen next in order to make money. Oh, what a concept. I know a lot of great traders. Okay, again, there I go, trading well, greatness, have reached certain levels of proficiency in trading, meaning by the metric of money. There could be other criteria or conditions that define greatness, and I'm narrowing this in. I want to be very specific. I purposely want to make a point explicitly of not avoiding money. It's energy, that's all it is. But energy is essential if it is, okay? So whenever I say greatness in trading or investing, etc., I am by the scale of monetary advance or accumulation, period, nothing else. There is a random distribution between wins and losses for any given set of variables that define an edge. Aha! If you come to terms with that, you're going to be more forgiving of yourself or of your activity if you experience a loss, a business expenditure. As I previously said, we should redefine the terminology. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. Okay, very important. I could not have said that better. Brilliant concepts. How to embrace risk. Distinguish the micro from the macro. From the macro, a particular pattern may have a certain edge. You got a head and shoulders pattern, for those of you classical chart pattern. You think the market's in wave 3, and you understand Fibonacci analysis, or you see a gap and you've heard that the gap will be filled at some point, and therefore the market must retrace on itself in order to fill that gap. Okay, that's a pattern, but that's the macro. How do you know it's worked 78% of the time in the last 10 years on your system, let's just say? So how do you know it's going to work this time out? All right. Someone's writing a long message. I'll get to it later. A particular pattern may have a certain edge. From the micro, at any moment, underlying market structure is different. This is why no particular pattern works all the time. What this is saying is it's an important detail. The patterns work to the extent or the frequency of times that they work based on the law of large numbers. But they don't work perfectly each and every time out because of the middle sentence here. From the micro, at any moment, underlying market structure is different. What that's saying, let me break that down. That's saying that there are essentially, to make the point, an infinite number of ways or ways by which a certain singular macro pattern can manifest. You know, it's kind of like I have this system, it works 92% of the time. I go to tell them I work for a trading firm, an investment firm. This actually happened to me one time. I worked for a company, I was in the World Trade Center in New York City, a brokerage firm, and a coworker developed a system that he thought was very high-end performance, over 90%, so he thought, and went into the founder of the company, his office, and said, I guarantee you the market, such and such a market, I think it was oil, was going to reach, crude oil, was going to reach such and such a price before the close of the session today. The head of the company had a very, very, very large account and said, oh, really? And put on a position. This actually happened. I'm sure it's happened many times. It's become a cliche. In order to prove the trader that had the confidence in their methodology and system and their projection and forecast wrong, he put on a position contrary to what the developer was saying to show that it didn't. And this is evidence of all it takes is one trade, one activity, one micro component of the macro pattern to change the outcome of correlation. This is why no particular pattern works all the time. Cognizance of the above will keep you from discriminating edges. What that means is you have a system, you can't pick and choose, oh, I don't, that's where your emotional internal state, well, you're interfering with the distribution of outcomes, which in turn has been fueled and is supported and being driven by the law of large numbers. The moment you start picking and choosing, oh, I got a signal from my methodology, and you decide for whatever reasons, however lofty and valid and appropriate they may seem to you at that moment, not to take the trade, the moment you do that, sometimes it might work to your advantage, other times not, but over the course of things, you are interfering with the process. And you're interfering with it because you don't have the correct internal state. You're thinking that it's an attempt, it could be any reason under the sun why you attempt to. Ultimately, at the end of the day, it's because you're concerned, you're trying to avoid risk. How absurd is that? You're in a neighborhood, you're surrounded by risk, and you think you can avoid it. You're immersed in risk. Why would you... Let me move on. I think we get the point. Right. The final answer. This is when Jim Sloman and others over the... I think I knew it intuitively at some points from the Buddha, you know, to cite a philosophical, metaphysical teacher. This is not a webinar on metaphysics in the slightest, but an idea, a truism or a truth is a truth regardless of the realm in which you apply it and appreciate it. The final answer is detachment. You must to be successful, that's the most important thing I would ever tell any beginning trader or any trader, experienced, intermediate, wherever you are in your curve of success in this business. The most important attribute you should have is one word, detachment. You got to be completely detached from any and all financial outcomes. I don't know anything more important than that. I would say I would give up, I would willfully forget every system, every bit of Elliott wave, every bit of Gann, every bit of candle, and everything I've ever learned to really be detached. Now, I'm not suggesting and not saying, I didn't say what I just said as license. I'm not saying you should no longer apply yourself and learn and acquire and appreciate and utilize the mechanics of the business of the analysis. Certainly not. But I cannot place a price tag on the importance and the essential ingredient attribute of the property of detachment in this business, or the state of detachment. Is lack of confidence holding you back? or versus is lack of edge checking, because you have, to the point I just mentioned, acquiring the correct internal psychological componentry, meaning you're refining your internal state so that it is the optimal template and receiver for the output of your analytical efforts, your tools, your methodology, your system, whatever you use, from the simplest to the most complicated, to the most ugly to the most elegant, and the most weakest to the most powerful. I don't care, whatever it is, it's got to be exported to your internal state sufficiently, with enough potency and enough verve for you to pull the trigger. Otherwise, you'll never affect the landing. You'll never get the money in your account unless you know something I don't know, which you could. But barring that contingency, good luck. But what I'm not, I'm not saying, again, relative to what my last statement concerning the previous slide, make sure you have developed your methodology. Get the one without the other is, we're playing with a not full cup. All of these three things, the methodology, which is your analytics, your analysis, your tools, your internal state, which is the receiving ground that's going to put it action to the output, of what your system has derived, and the money management. Lack of edge, so make sure you don't have a lack of edge. That's the analysis stuff, is all. And assuming you have that edge, have a even-keeled confidence in that. Okay, is all that this slide is saying. Psychology, coming full circle here, begin to reach towards the shelf of what I mentioned we wanted to put on at the beginning, which was the universally known equation of one Albert Einstein, E equals mc squared. Whether you understand what that's about, its ramifications, what it means literally or figuratively is irrelevant. I will break it down, but we've come full circle. What is psychology? Well, in a broad sense, it's the scientific study of the human mind and its functions, especially those affecting behavior in a given context. All right, so the future, a new perspective of trading psychology. I think I've made a case that being detached, if you are detached, not being uninvolved, but being detached, will paradoxically enable you to realize the financial, monetary objectives you so preciously may desire, let's say. Okay. If I'm detached from an outcome, I'm more clear, I'm better able to clearly see what the market, the information the market in its motion is giving off to me and presenting. I'm be a better decision maker. A new perspective of trading psychology, measurement versus direction. And this is kind of an example to illustrate the juxtaposition of two ways of thinking of this. If I were a student and I asked, and I were explaining to my teacher the process I take of learning, it could go something like this. In a way, I suppose, but I use my voice as a ruler, measuring the words of my teachers with my intuition or some faculty I picked up. I don't originate a thought or idea. I simply evaluate it. Evaluation is one type of measurement, essentially. Well, the teacher's response is, okay, that's fine insofar as it goes, and but for moving beyond that, and why do you do this? Being a little rhetorical. In other words, why do you assign yourself the diminished role of measuring? Alone, I might add, put in there. But measuring is fine insofar as it goes, but here, have you considered analyzing instead of measuring and analyzing, which is all the measurement side, the left side, but the direction being proactive in creating an invention? Aha, that's a new idea I wanted to present at the end of this program. Creation, inventing, formation versus measurement of what is. Here's an example of the measurement paradigm. A basic premise of technical analysis is that all information, let me just slide this up, make sure we're, all right. All information is is that all the information one needs is contained in the price. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. In other words, this space-time, or more specifically price-time continuum of energy, is what we are observing when we view a price chart. If and when this energy, which represents the market, moves by a certain specific amount of price time, it reaches an equilibrium point of balance. Because by definition a balance point is so sensitive, it marks or corresponds to a point of change or a turning point. Essentially, tops and bottoms are points of resonance that allow energy to come in and overflow the system so that change is occur. Changes in a specific type of change as a market reverses. Now, everything on this slide is just my personal view. I don't think it's that far. I think more or less many traders might see, if they don't agree in total with some of it, at least. But it's my view. I'm not trying to sell this or put this on anyone or force it on you. It's just my viewpoint, a view. But never. It's a second. It's not all that great a view. It is a view. It's maybe relatively on a continuum of degrees of effectiveness, somewhat satisfactory. I give it a C+. Versus, here's a redoing of the basic elements that are essential components, but from a completely different. I'm wearing a new pair of glasses, a different paradigm of application of the similar, containing all the same information, but reworked. An active psychological, a recasting of all of the components, but reapplication. Here it is. Same idea, each one of the points in the previous slide is recast in this slide. A basic premise of psychological and or behavioral speculation is that all market motion, past, present, and future, originates and is informed by energy. Think energy and money as being equivalent, which emanates from the speculator. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. In other words, the space-time or price-time continuum of energy is what we are creating when we interact with a market and its chart. So let me stop right there. Let me just quick comment, interject. On the one hand, I can look at my price chart and based on everything I know, moving average interaction, oscillator, wave count, candle formation, classical pattern formation, volume price correlation, open interest, you name it, trend line intersection, anything from A to Z, all the things I just mentioned and everything I didn't, that you believe when put together in a certain combination and you've tested, generates certain statistical results. Okay, that's your analysis. Okay, that's what most traders, or that's what I tend to do most of the time. Which is completely the flip side of that coin of analysis is instead when we are creating everything, what I normally do is we are taking account of, we're registering and writing down the results of our registrations. What's the value of my RSI? What's the value? Where is the crisscross of the exponential moving average? And if and when it occurs, is it congruent with a certain candle, a hammer or a shooting star candle pattern, etc., etc. I could go on. But juxtapose that, which is a completely one thing, which is a measurement type of activity, which is completely the exact polar opposite of if we are creating when we interact with a market and its chart. If and when this energy, we're now not a passive observer taking notes and writing down the readings of our indicators, but instead we are creating the effects. We're the causative driver of an effect as opposed to the passive viewer of the effect. If and when this energy, which represents the market, is moved or manipulated by, let me interject, by you and me, the operator, the trader, the investor, in a specific way, through certain amounts of price time, it reaches an equilibrium point of balance, because by definition a balance point is so sensitive, it corresponds to or marks a point of change. In other words, the market turns. So there's a paradigm shift here. On the one hand, I can observe what's going on and take detailed measurements in all infinite number of ways. On the other hand, I could be responsible for creating the phenomena what previously I was observing and measuring and monitoring and making and reaching conclusions based on my measurements. Two opposite polar, I submit possibly complementary phenomena, but completely opposite activities. Ballparks apart, universes apart, because by definition of, okay, when the collective energy reaching the market achieves a sufficient degree of resonance sufficient to create an energy overflow, the market reverses. Mental manipulation, teacher to student, the universe responds, and let me qualify this. I remember a couple of years ago I included this slide and someone vehemently protested that I was trying to present some religious or philosophical or metaphysical or whatever view. I'm not. This is just an example. I have nothing, this is not in any way propaganda towards religion or with regard to religion or some viewpoint of thought. It's merely, the gist of this paragraph is merely, or interchange between a teacher and a student, or is to indicate the deeper, more critical point relevant to the process of investing that the last slide indicated, and that is be an active participant in directing your energy to create the system phenomena that if you're not, you're merely measuring. You're just observing. You're a passive observer making measurements. The universe responds to your directives, not your questions, hopes, and prayers. If you choose to define your future by telling the universe what you desire to experience and appreciate, and you hold these thoughts in your mind with fierce persistence, the universe, by its own design, will respond accordingly. Again, if you accept that, great. If you like it as a good concept, great. If not, it's so what? Doesn't matter. It's not neither bad or it's something I happen to agree with. If, on the other hand, you ask questions and pray for answers, the universe will respond with a deafening silence because you have not given it direction. So that final statement assumes that we, you and I, are part of the market. We are not passive entities out external to the market, merely registering by virtue of observation of a certain indicator or set of indications and drawing our conclusions analytically from such, and to go all for the purpose of making a trading decision, which in turn ultimately, assuming we have a receptive template internally in our internal state that can act on that information. Instead, this presents the final sentence is, if on the other hand or the previous sentence, the Thompson says, I can be an active engine and generate the phenomena. I also, having generated the phenomena, I can simultaneously, one does not exclude the other is the point. All right. One final point, and I wanted to relate the E equals MC squared idea. If money is energy, which I maintain it's a form of, and the famous world universally, everyone knows E equals MC squared. It just occurred to me a little while ago. That equation says E, which is energy, M stands for mass. Anything that you can see, touch, anything that's matter is mass. His equation, whether we understand it or not, says that mass and energy are one and the same thing. The little c, which represent the letter C in the equation, E equals MC squared. I should have put this on a slide. I didn't think of it until a little before today's start of today's program. Otherwise, I would have put it as a slide in case you can't visualize this. But E equals MC squared is one of the most, if not the most famous equation in the history of mankind. And it stands for energy equals mass times the speed of light, which is, they use the letter C to represent the speed of light, squared. The speed of light is, what, 186,000 miles per second. If you can wrap your head around that, but that's, I believe, if I recall, that's what it is. And they're saying if you take an object, why do I say an object? Because anything that's matter is mass. So let's say you had any object you can, in your eyes sight right now, a pencil, a pen, a piece of paper, your phone, a piece of fruit in your kitchen, in your refrigerator, anything that has mass, if you could somehow, some way, however incomprehensible it might seem, put it on a vehicle that's traveling at a velocity, the speed of light squared, it would change to energy, pure energy. That's just what the equation says. Whether or not it's true, I'm just going by what the equation says. If you could do that, they are one and the same. So let's think about this. If we have this relationship, they're one and the same, that gives you and I, the operator, tremendous capacity. The thoughts that we think are essentially have the capacity to move markets in the extreme. I just cite that as Exhibit A.
Hey, I'm about to go in there right now. However, my colleague is using the GoToWebinar thing, and he's supposed to have wrapped up half an hour ago.
Ooh, Ken, I'll be out. I'll be right off.
So we
let me end this. I didn't know we had other. Okay, so I'm going to end this, Ken. Give me a second, and I'll be out. Ooh, didn't know.
Let's give him 20 minutes.
Okay.
20 after the hour. If not, I'll cut him off back then because he's half an hour overboard already. So it'll be a 1 hour presentation that he was doing. I'll go in there at 3:20, 4:20 Mountain Time. All right, thanks, bye.
Right, thanks, Ken. All right, I'm going to end. I didn't know they had
if you go in there and you see that some previous thing is still in session, that means he's still carrying on, and I need to maybe call him or something. But I'll give him 20 more minutes. All right, thanks.
I'm done in 5 minutes, Ken. All right, folks, we're going to end. They had another program scheduled, so just a final wrap-up. We conflicted with another schedule. So we have a wrap-up in the gold market. This is my last webinar that I gave, and the update is it's doing exactly what we had projected in my report, I guess, about a month ago, where my next turning point is projected for a week from yesterday, which is February 1st, so I expect gold and precious metal prices in general to decline into 2/1, which is Wednesday of next week. So just for those of you who saw the previous program and are expecting or wondering or trying to put into context the price action you're seeing in the metal sector, that's by way of explanation. I believe it will complete a correction wave 2 on or about February 1st, which is next week. That's the update on the trade that we presented in the previous presentation. Lastly, just so in case those of you have wondered, just as a